Tesla closed up 4.2% today, May 11, 2026, landing at $446.31 per share. That's a meaningful single-session move for a company with a market cap in the hundreds of billions. But here's the thing. If you've been watching Tesla in 2026, a 4% swing isn't exactly shocking. This stock moves. The more interesting question isn't what happened today specifically. It's what has structurally changed about Tesla's story that makes investors react this sharply to any piece of news. Because the company you're looking at in 2026 is genuinely different from the Tesla of 2022 or even 2024. The EV monopoly era is over. The margin squeeze is real, and new revenue lines, energy, software, autonomy, are no longer theoretical. So let's unpack what's actually driving this stock. Start with the market backdrop because it matters. The S&P 500 proxy, SPY, is sitting at $740 today, and the VIX, Wall Street's fear gauge, is at 1813. That's elevated compared to the historically calm readings of 2024, but it's not panic territory. What it tells us is that the broader market is in a cautious but functional state. Investors aren't hiding under the desk. They're selectively buying names they believe in. In that environment, a stock like Tesla, high beta, sentiment-driven, with multiple active narratives, tends to swing harder than the index in both directions. When there's a positive catalyst, real or perceived, the move gets amplified. So today's 4.2% jump isn't happening in isolation. It's happening in a market that's anxious enough to punish bad news, but hungry enough for returns to chase good news aggressively. Now let's talk about the EV landscape, because this is the foundation of everything. By May 2026, the US electric vehicle market is no longer a Tesla story. It's a multi-brand battle. Chevrolet, Ford, Hyundai, BMW, Rivian, they all have production EVs in showrooms that have been shipping for at least 2 years. Global competition is even more intense, with Chinese manufacturers continuing to push on price. Battery costs have come down industry-wide, which sounds good for consumers, but is brutal for any company trying to hold a pricing premium. Tesla's response to this competitive shift starting in late 2022 and into 2023 was aggressive price cutting, which defended volume but crushed margins. That strategy bought market share, but it came at a cost that investors are still processing. The question hanging over Tesla isn't whether it can sell cars, it's whether it can sell them profitably enough to justify its valuation. Which brings us to margins, arguably the single most important metric for Tesla right now. Tesla's gross margin peaked at around 29% in early 2022, according to its public earnings filings. The price cuts that followed shaved that down significantly through 2023 and into 2024. By 2025 and into 2026, Tesla's stated strategy shifted toward defending and rebuilding margin rather than purely chasing volume at any price. That means leaning into higher margin product variants, optimizing the Gigafactory production lines, and critically, reducing headcount. Tesla executed a significant workforce reduction in 2024. Any signal that this strategy is working, stabilizing margin, improving operating leverage, or disciplined pricing, sends the stock higher. And conversely, any hint that price cuts are returning triggers a sell-off. Today's move likely reflects some optimism on the margin trajectory, whether from analyst commentary, supply chain data, or informal guidance signals ahead of the next earnings print. The Cybertruck is worth its own beat, because its role in Tesla's story has evolved considerably. The Cybertruck began deliveries in late 2023. That's now over 2 years of real-world production and sales data. Early production was slow, and the margins on the first units were reportedly thin. Tesla itself acknowledged this in shareholder communications. But the vehicle has genuine demand, particularly in the US truck market, which is one of the highest revenue segments in the entire auto industry. If Cybertruck variants, trim levels, or a higher volume production run in 2026 are showing improved unit economics, that's a legitimate margin catalyst. Beyond Cybertruck, Tesla has continued to hint at a lower cost model aimed at broader affordability. Any credible update on that program, timeline, pricing, production location, would be a material event for the stock. investors are paying close attention. Here's the part of the Tesla story that often gets underweighted: energy storage and software. Tesla's energy business, Megapack and Powerwall, has grown from a footnote into a meaningful revenue line. In 2024, Tesla reported record energy storage deployments, and grid-scale storage demand has only accelerated alongside the build-out of data center infrastructure across the U.S. This isn't a small story. Megapack deployments represent high-margin recurring business compared to the capital-intensive auto manufacturing side. And then there's full self-driving. FSD has been in development for years, but the revenue model it enables, subscription fees, potential robotaxi licensing, data monetization, remains one of the most debated topics in tech investing. Tesla hasn't cracked the fully autonomous commercial deployment yet as of today, but progress on FSD capability is directly tied to investor willingness to assign a premium multiple to the stock. If today's move has any AI or autonomy flavor to it, that's the mechanism. Let's ground this with a valuation reality check. At $446.31 per share, Tesla is not a cheap stock by traditional auto industry metrics. Legacy automakers, Ford, GM, Toyota, trade at single-digit price-to-earnings multiples. Tesla's multiple is dramatically higher, which means the market is not valuing Tesla as a car company. It's pricing in the energy business, the FSD optionality, the robo-taxi potential, and the brand's cultural footprint. That's either a justified premium or a fragile one, depending on whether those growth narratives execute. The practical implication: Tesla is extremely sensitive to sentiment shifts. Positive data points, margin beats, FSD milestones, energy deployment records, can add billions to the market cap in a day. Negative ones can subtract them just as fast. That's the stock you're watching when you track TSLA. No analysis is complete without the other side. The risks to the Tesla bull case in 2026 are real and specific. First, Elon Musk's attention continues to be divided across multiple ventures, and executive bandwidth is a genuine corporate governance concern that has shown up in institutional investor commentary. Second, Chinese EV manufacturers, particularly BYD, have continued to expand, and their presence in markets outside China is growing. If Tesla loses pricing power internationally, the margin story gets harder. Third, the regulatory environment for autonomous vehicles remains fragmented, state by state, country by country. A setback in FSD approvals or a high-profile incident could reset the autonomy premium the market is assigning. And fourth, interest rates. While the Fed has adjusted rates multiple times since 2024, the rate environment still matters for big-ticket consumer purchases. Any tightening in auto loan conditions hits EV demand across the board, Tesla included. So what's the bottom line? Tesla moved 4.2% today. That's a real number. $446.31 on a company that analysts, short sellers, and long-term bulls all watch obsessively. But the single-day move is almost secondary to the bigger structural story. Tesla in 2026 is a company navigating a genuine strategic pivot, from high-growth EV monopoly to a multi-business platform that includes energy storage, software subscriptions, and autonomous driving ambitions. The transition is messy, and the margin math is still being written. What makes Tesla worth watching and worth understanding is that it sits at the intersection of three of the most consequential industrial trends of the decade: the energy transition, the AI build-out, and the restructuring of personal transportation. Whether today's pop is a signal of something durable or just noise in a volatile name, that's the question every holder is asking. And the data, not the hype, is the only way to answer it.